I'm Haze Hartwig. This is Bamboo, Vancouver's property management and investment podcast. Hello, everyone, and welcome to Bamboo, Vancouver's property management and investment podcast. Today on the show, we have Chad from the Collective Mortgage Group. He's going to be talking to us about investment, mortgages, and the ins and outs of that, just as a high overview. And so without ado, welcome to the show, Chad.
Cool. Thanks for having me. Appreciate it.
Yeah, no worries there, man. So you've been in this mortgage game. You're a generational as well. Sort of like I'm multi-generation for the real estate stuff. You're multi-generation for the mortgage.
Yeah, too true. This is actually my 21st year in the business. I got into business similar to you with your scenario. I got into business with my dad way back in the early 2000s, and I've been running with it ever since. I took over the company in 2010, and I've been operating it ever since. Collective Mortgage Group has been around since 2020 when a partner and I formed it on our own, and right now we're operating just under $1 billion in total revenue as a franchise, with 14 brokers under the umbrella. So
that is a lot of goings on.
Yeah.
Cool. So kind of more gearing towards investment. What are the types of mortgages there, and what do you figure is the best for investment as far as fixed term or variable, or what do you feel is a good way to tackle that one?
Yeah, I mean, typically speaking, when you're looking at investment properties, any type of investor really likes cash flow certainty.
Of course.
So on that side of things, fixed rates tend to be geared towards for investment properties, but you also got to look at the market and where you're at when you're buying. We're looking at the market right now. Fixed rates are actually significantly lower than variables. So another reason why people would be taking a fixed rate right now is there's some big savings to be had. So when you're running the numbers on how much cash flow you can get out of an investment property, the security of a fixed rate right now does seem to be beneficial. But that's not always indicative of what it might look like at any given time. Variable rates always have a good return as well, just at different times right now. Rates have been significantly higher for the past 12 months, and that's leading into why fixed rates maybe are winning right now. But you just got to look at everyone's situation at the time you're getting it. Case to be made for both, certainly.
Okay. Now, generally speaking, the variable is usually lower than the fixed. This is kind of an unusual time, right?
Like on average, I would say a good ballpark would be variable rates are typically 0.75% below a fixed rate, which is why you would have the trade-off of maybe that's why we go with a variable rate. You're getting that upfront and immediate interest savings. We're in what I like to call an inverse interest rate market right now. Typically, even on the fixed rate side, you see that 1 year or 2 year or 3 year fixed rates are lower than 4 and 5 year. The longer term you go, the higher the fixed rate is. But right now, we're seeing shorter term fixed rates higher than longer term fixed rates. And we're seeing variable rates significantly higher than fixed rates on a whole. And that's just because, most economists, the market is projecting that in the next few years, rates should be coming down. So they're pricing shorter term fixed rates higher for profit taking. And then in a few years, those rates will come down, and you'll see that switch back and forth.
Yeah. So you think maybe it might be, there is a case maybe perhaps to get the variable and try to ride out the storm and maybe ride that back down eventually.
Totally. Everyone's situation is so unique and different. If you take that variable rate and you're starting with a higher percent, you have to be maybe willing to maybe go through a bit of a cash flow crunch in those first few months. But I certainly think there's merit in considering a variable rate, and because we are going to see rates come down. I think the major projection is that within 18 to 36 months, we should see rates significantly lower from where they are today.
So that's something to definitely take into account when you're trying to figure out what mortgage to get.
For sure.
Which sort of leads to the next kind of ponder on that, is that before you're getting a mortgage for investment, what are some pre-checks or preparations that you should make before you make this leap? Because you're going to be it's kind of a different beast than your primary residence, as it were.
Yeah, for sure. I mean, aside, we'll take out things like down payment for now because I know we'll get into that a little bit later on. But if you're at all considering getting an investment property, you always need to know what your incomes are looking like. You've got the ability to cash flow that property should you not be able to rent it. And I know that, we always talk about things like vacancy rates, you and I. They're at all-time lows, and really in most major markets here in the Lower Mainland.
Absolutely.
It's not like it's hard to get a tenant, but that doesn't necessarily mean that you might not have a gap of a month or two in between tenancies, and you've got to be able to carry that property for a few months.
Yeah, so a good idea to have some backup.
Yeah, savings. You've got to be able to have a nest egg available in case there is that dead zone in between rentals.
Yeah.
If you lose a tenant, you got to be ready. You've got to be ready to, I think we talk about this sometimes from some of your horror stories, right?
Yeah.
You got to have some money available to put some fixes up into it.
Yeah.
So on top of what you need, obviously, just to buy a property for down payment and closing costs, having a little bit of a backup is I think paramount when you're looking at getting an investment property.
Yeah, absolutely. Especially you're saying for fixes and stuff like that, just because, general maintenance is something we hammer on this show all the time. It's general maintenance.
I don't think enough people look into it. Like, if you want my honest opinion, right? I don't think people look into getting an investment property and then maybe earmark enough aside for what that's going to look like of, hey, maybe we're going to need to do these floors in 4 years, or, what a repaint looks like.
Well, exactly. And it's funny that you mentioned 4 years, because by the RTB standards, paint on a wall has a life expectancy of 4 years. So theoretically, plan to paint your place every 4 years, give or take. I mean, sometimes you can squeeze more out of it, but that being said, if push came to shove down there, you'll probably be asked by the RTB, the arbitrator there, how long was the last time you painted for? And if it's more than 4 years, then they may toss your case. Basically.
Yeah, totally. And I mean, let's be honest. Like, you're buying an investment that's you're spending several $100,000 on. You got to be willing to put the work in and maintain it. Otherwise, you're just letting a good asset depreciate.
Yeah, it'd be kind of like having like a 67 GTO and just letting it rot.
Totally, not getting an oil change, right? Exactly.
Right?
Yeah.
For sure.
Couple of car guys here.
Yeah, right? Which is also my dream car, by the way. 67 GTO.
Right on.
Want that for sure. So, as you touched about, we're saying, what are some of the basic qualifications for getting an investment property, and are they different from a primary mortgage?
Yeah, totally. I mean, great question. So it is one of the questions we get asked a lot when it is investment property. So investment properties, specifically speaking, you need a minimum of 20% down. Okay. Where you're buying a primary residence or your first home or an owner-occupied property, purchases under $1 million, you can still do default insured, which means minimum down payments. Under $500,000 is only 5% down. And then it's a tiered down payment system up to $1 million purchase. But any type of investment property at any purchase price, 20% down is the minimum requirement.
So, I mean, it would be some case to put perhaps, if you're, maybe on the younger and easier to move around, to maybe buy a property, live in it for a while, and then move to the new one, because you can just put 5% on your primary and keep that previous. That's a reasonable method. Yeah, you
got it. It's actually one of the plans I talk to a lot of clients about when they are looking to buy their first property is, they might not have thought about what long-term real estate looks like for them. And so we say, okay, well, if you're looking to buy this property, what's next for you? Maybe you're in a relationship. We know you're going to be upgrading at some point in the next 5 years. So do we buy it with the intent that you're going to want to hold this property as an investment? It's actually one of the best ways to grow your real estate portfolio, because you've already spent the money on closing costs, things like property transfer tax and legal fees to get in. And we all know how expensive it can be to sell a home as well, by paying real estate fees and then getting a new home with new property transfer tax and closing costs. So if you have the ability to turn it into a rental down the road, it's a great thing to do as you continue to upgrade your properties, turn them into rentals when you move out. Yeah,
absolutely. And I guess now with the rules that they brought in 2023, which opened up all the rentals, right? Now it's a whole new ball game.
Yeah, a lot more options for people that previously lived in a rental restricted building.
Yeah. Now, with those new rules, have you seen an uptick in that? People were kind of concerned before about there's going to be suddenly everyone's renting in that. Have you seen more of an uptick in people getting investment, or just kind of even
No,
flow?
not yet. Do I think it'll come? Maybe. I think, we've seen a lot of people sitting on the sidelines for the last 8 to 12 months as
absolutely.
interest rates have taken off.
Yeah.
We've seen a 4% increase in interest rates over, since the start of 2022. And so getting an investment property, I don't know, has been priority one for a lot of people for that reason, because cash flowing it now at higher rates is hard.
Oh, absolutely.
So we haven't seen a lot of it, but do I think that in the next couple of years, as rates come down, you'll start to see a more influx of people getting into it? Absolutely. I think everyone's going to be looking for how's the next best way to leverage their money, and getting an investment property when rental restrictions have now been removed. It's going to be a great opportunity for a lot of people in the next few years.
Oh, absolutely. And it's interesting with how the rates have gone up. It is tied right into the rentals. And that's one of the things that I think a lot of tenants in particular are just not aware of. You'll hear people at, a cocktail party or whatever and saying like, oh, I don't know, and so I don't care about the mortgage rates. It's like, well, you kind of do, because all these guys who are on a variable have now gone up. I believe you said 4%.
4%?
That's a lot of dough, because what was the calculation, if you remember, for 1% of going up?
So I don't have that on me, actually. That's a good question. I'll run some numbers right now. What I can tell you is when we used to do calculations of when interest rates went up 0.25% at a time, on average, it was about $13 per month for every $100,000 you borrowed. So if we're running that math, $13 per $100,000. Let's say you have a $500,000 mortgage, right? We're looking at $65.
Yep.
And then now we've gone up 4%.
Yeah. So
multiply that. Yeah. It's a big increase in monthly cash flow for
absolutely.
sure.
Yeah. So that's sort of like how they're tied in. And I think it's interesting that a lot of people don't realize, if they're not an owner, that you are inherently tied to that still. Even when you don't have a mortgage.
They're passing that cost on at some point. If it's costing them more to mortgage that property, those rental rates are going to go up as well, for sure.
Absolutely.
Yeah.
So now, as far as, you're a mortgage broker, there's mortgages at all these banks. You walk into Scotia or Royal or whoever and ask for that. Why would they use you over doing it themselves?
Yeah, a little bit of self-love here. Multiple reasons, I think. And I'm not even going to call these biased reasons, but for one, the consumer doesn't know what they don't know. So my job as a mortgage broker, and I really actually advertise myself as an independent mortgage broker, which means I'm not affiliated or biased in any way by working with one lender. We have access to many, many lenders across Canada, many major big banks, mortgage finance companies, which we refer to as lenders that exist specifically in the mortgage broker space that you couldn't access as a consumer unless you went through a broker.
Okay.
So we don't sell one specific bank's product. We know what all of the lenders individually will do in terms of how they will finance. They all qualify very differently as well. That's one thing a lot of consumers don't, I think, appreciate very well, is that, let's use two of the bigger banks, Scotia and TD, as an example. They look at qualification very differently. You might be able to qualify for a rental property or even a primary residence with Scotia significantly higher than you could with TD, because of the way maybe they consider rental income, or maybe you have a net worth of investments that we can utilize to qualify for a higher mortgage amount. So, a mortgage broker, and specifically myself, we'll do a little charity pump here. We can help walk you through that. We can say, listen, here's this option here, and here's this option here, and here's the pros and the cons to each side of it. And that's what we can help deliver. So that's, I think first and foremost, choice, option, unbiased opinion on what lenders are the best to deal with. And then from there, my services are paid for by the lenders for bringing quality and qualified business in the door.
Yeah.
So that's not built into the mortgage in any way. You don't pay out of pocket for my services.
But I was just going to ask you, what's the fee for this? But free is a pretty good number. I think that's a good number.
Totally, free is a really good number. I think the similar comparison is the travel agent. If you want to go on a big trip to Europe and you've never been there, sure, you can leverage your family and friends, but you can go to a travel agent agent. They can help you book that trip, and they get paid by providers for, helping you plan that trip. You're not paying for their services as well. So that's always been a similar comparison in the broker industry. Our services are at no cost in most cases. I do say most cases. Commercial financing, there's some cost that's billed onto the consumer, or private lending, which we won't get into today, but those sometimes have fees involved with them. But I always say 99% of the time, especially in my business, AAA clients, clean credit, clean income. No cost in my service.
Okay, well, that's a good thing to know for sure, especially getting involved in a new area for people trying to get into investment. I mean, it's a good thing to know that you can kind of save a couple of bucks there, as well as some legwork and time. So that's a nice thing to go in there. Now, with mortgages, there's sometimes penalties for paying back early and stuff like that. Does this apply to all mortgages, or is there different products that have this and don't have this?
Great question. Getting into, kind of tying back in with the last point as well, is those are all the points we go over when we're talking about it. But there's many different kinds of penalties. So if you have a variable rate mortgage, I always tell clients it's the cheapest penalty you'll ever pay on a mortgage. It's only ever going to be a 3 months interest penalty.
Okay.
And that is the cheapest penalty you pay. If you have a fixed rate, generally speaking, there's one of two types of penalties the bank's going to charge. And lucky them, they have it in their wording. They'll pick whichever's higher, and you'll pay that. It's a 3 months interest penalty, or what they refer to as an interest rate differential. Hard to go over what that calculation looks like right now, but it looks at the rate that you have versus what an equivalent rate would be at the time you're breaking. So if you, let's say, took a 5-year fixed rate, you're 2 years into it, so that means you have 3 years remaining, and you wanted to break that mortgage, they would compare your mortgage rate with what a 3-year fixed rate they're offering is at that time, and then they take the differential, and they times that differential by your mortgage amount, by the amount of years you have left.
That'll stack up, huh?
And it can. Generally speaking, we see interest rate differentials, they say on average, are about 3 to 5 times as high as a 3 months interest penalty.
That is definitely a huge difference. So,
totally. And a lot of clients get into that without knowing. And that's one of the biggest, for me, decision makers is when you're getting a mortgage up front is what is the possibility you might break this mortgage within the 5 years? Because if you've got a growing family and you're in a condo, 1 bedroom, 2 bedroom, and there's a couple of kids, you might want out of that in a few years.
Yeah.
So is taking a 5-year fixed rate the right option for you? It might be the lowest rate right now, but lowest rate right now doesn't mean best option for you long term, because if you end up paying a significantly higher penalty in 2 or 3 years from now, we got to look at what that total cost of financing looks like.
Oh, absolutely. I mean, it's kind of interesting you touched on that, because I explain to a lot of our clients that sometimes the lowest number isn't always the best one, especially there's some that are not portable. If you don't mind touching on the difference between that, because we may have some people who are brand new here and wonder what a portable and not portable mortgage is.
Well, I mean, and that is a parallel in your and my business, is that, educating a client, educating a consumer about, again, why to use me, but, we have to look at, it's not a trite thing to say that we have to look at everyone's picture as a whole and really educate them about why we're doing this. Building a plan and making sure that they understand exactly the product that they're getting into is just as important as me getting them the lowest rate.
Yeah,
lowest rate, just like what you said, is not always the best option. If it means that we know the likelihood of them breaking a mortgage within the first few years is going to be high, doesn't necessarily mean it's the right rate or product for them. But just to touch base back on other types of products that might exist that don't have penalties, the big difference that I see in my business is the number one education that I provide clients, the difference between fixed and variable versus open and closed. I'll have clients call me all the time that say, I got a 3-year closed mortgage, and they think that means fixed. Or I've got an open mortgage, and they think that means variable. Variable and fixed have to do with the rate. If you have a fixed rate, it's fixed for the amount of time you have that, and it does not fluctuate. That's specifically what fixed means.
Okay.
Variable means that you have a rate that is variable and can fluctuate. And that fluctuates as the Bank of Canada increases or decreases their overnight rate, which adjusts consumer prime rate. Totally different than open and closed. Closed mortgages specifically mean you have a mortgage that if you break it, there will be a penalty.
Yeah.
And an open mortgage is a mortgage that if you break it, there's no penalty. Okay. So we look at things like lines of credit, home equity lines of credit for products like that. But you can have a fixed or a variable open, or you could have a fixed or a variable closed.
Okay.
So understanding the terminology is generally the number one thing I educate clients on so that they know what type of product they're getting.
Yeah, and speaking of terminology, what is debt service ratio and how does that apply to rentals?
Yeah, debt service ratio is the percentage of income specifically that we can use to qualify you for any type of a mortgage. So debt service ratio we use in terms of buying an owner-occupied, an investment property, a vacation home. Your overall debt service ratio is what lenders will look at in terms of qualifying you. So on average, the easiest rule of thumb, and this isn't one that a consumer could figure out on their own, but lenders will say we can use up to 44% of total income to qualify you for all of your mortgages, all of your debts. That includes credit card, lines of credit, car payments, student loans, etc. And obviously, when it comes to income, when we're talking about investment properties, because that's been the point of the conversation, we can factor in rental income on top of your employment income. Okay. So it's taking a look at all of the incomes and then all of the liabilities from mortgage, property taxes, strata fees, heat, and as well as any other debts. And that gives us a total debt service ratio, which is, ideally exactly what a broker does to qualify a consumer. And that's part and parcel of the first thing that we do when we're working with a consumer. We have to figure out what they can borrow and what their debt service ratio is.
Awesome. So you said that it does take into account of the rent. Does it take the full rent? Like if it was a $2,000 rent, does it assume $2,000 or does it cut that in half or how does it gear towards that to deal with the debt ratio?
And this is another benefit of using a broker. Every lender is so starkly different. We have lots of lenders that will say, we'll only use 50% of the rent.
Okay.
And we'll add it to your income. And I'll explain what that looks like simply. This one's an easy one to do, but let's say it's a 50%, what we call rental add back. So your rent is $2,000 a month. 50% of that's $1,000 a month. So we annualize that. So $1,000 a month over the course of a year is $12,000. Let's say you make $100,000 a year. If we go to that lender who uses a 50% add back, they're going to say, well, your employment income is $100,000 and the rental income is $12,000. So total income on file is $112,000.
Okay.
That's how much income you have to qualify for the new mortgage. It actually doesn't move the needle a lot. $12,000 of extra income is not really going to bump you up for a significantly higher mortgage. There's other lenders that will use what we call a rental offset. And a rental offset is where you look at the costs of the mortgage, property tax, strata fees, and heat on the new property. We'll figure out what the rental income is. So again, in that case, $2,000 a month. They will directly offset that property's costs. So let's say a new mortgage payment, property taxes, strata fees, and heat are going to be $2,500 for the month.
Okay.
They'll take a percentage of the rent, let's say again 50%, so $1,000. They would reduce that income down to, or they would reduce the property's expenses from $2,500 down to $1,500.
Okay.
So now you have to qualify for the new mortgage at $1,500 of expenses instead of $2,500. Rental offsets significantly go a lot further.
Absolutely. Sounds like it.
Yeah. And the average consumer wouldn't know the difference, but they also wouldn't know which lenders offer which. We have some lenders that will go as high as 80% rental offset on an investment property. And we have other lenders that will only look at 50% rental add back. And the average consumer won't know which one's which. But if you walk into your bank and you say, hey, I'd like to qualify for an investment property, they might have a significantly lower number for you for what you can qualify for than what we can get with another lender.
Okay.
So that's where a broker can come in and explain those differences.
Now, with them figuring out the rent, because obviously there's no just an appraisal like they would for a purchase, how do they determine how much rent you can get? Because there's obviously no one there. So how do they know? Or if someone's been there for 10 years, they're paying $1,100. So, I mean, you can't use the current tenant.
Totally.
It's too much.
Yeah, I mean, great question. So a few years back in Canada, it was mandated that appraisers actually now have to keep a log of market rents. And so when we are trying to determine what a market rent on a property would be, we do have to go through an appraiser. Okay. And they will use their now ever-growing database of what rents are. And appraisers really know the area that they're appraising in. So if we use an appraisal company in the Lower Mainland, they'll have specific appraisers that know each market: New West, Coquitlam, Vancouver, Burnaby. And they'll know that a 2-bed, 2-bath in Burnaby condo is going to rent out for $2,800 a month, as an example.
Yeah.
And so the appraiser will provide us what we call a market rent evaluation, a market rents letter, and that will determine what the rental income is that we can use, and that's what lenders accept.
Nice. Okay. So yeah, this is pretty straightforward. Yeah. At least they have a good gauge, not just pulling random numbers sometimes.
Well, this is also where I pick up the phone and call you and I say, hey, listen, I got a client who's looking to buy a rental and we need to know what that rent looks like in New West. And you're going to pull it up and say, here's what we can do.
Yeah, absolutely.
That helps me qualify them before we even have a property in place.
Yeah, that makes sense, right? So now with that, we were talking about the banks lending and all that. If it doesn't cover the nut, and by cover the nut, I mean cover your strata fees and heat and property taxes and all that, will the bank lend, or are they just like, nah, you're going to be dragging too much money and that sounds like a bad investment?
Yeah, no, they will. And again, this is where the strength of the borrower comes in. This is where the borrower needs to be able to carry that shortfall on their own. So lenders will look at it and say, okay, well, there's going to be a rental shortfall on this property of $1,000 a month. Can the client's income service that rental shortfall? And if the answer is yes, based on those, debt service ratios we talked about, they will still finance that rental property for them because the client's proven with the ability of income they can service it. They might be a higher income earner, and they're okay taking a rental shortfall on it. But in most cases, the debt service ratios are going to come back into play here and determine whether or not the lender's going to do that.
For sure.
Yeah.
So now we were talking about people who are already in their place, or they've had an investment place and that. And one of the terms that comes up a lot of time is equity. For starters, what is equity?
Yeah, good question. So equity is basically the difference between the value of your home and what is left on the mortgage. So we'll use a real simple explanation. Let's say you've got a nice home, condo, it's worth $600,000. Your remaining mortgage on it is $300,000. You have $300,000 of equity.
Okay, so a lot of people use their equity, now that we have a determination of what it is, to use that to sort of leapfrog and purchase sometimes a car, but they should be purchasing real estate, in my opinion. No bias, of course.
Yeah, of course.
But for that, they obviously, I'm assuming, can't take the whole $300,000 off in this example. Is there a percentage, a magic number?
Yeah, of course. So, in the only way you're ever going to get access to your full equity is if you sell your home. Oh. You sell your home, you pay your real estate fees, whatever you're left with, you walk away. In financing, when we are looking, the term is refinancing. You own a property, you have a mortgage on it. We want to refinance to pull money out for whatever that purpose is. And I agree with you. This is something we work with a lot of clients, pull money out of their property. They can use that and leverage it as down payment for their investment purchase. So we can refinance a property up to 80% of its value.
Okay.
So using that same example, properties worth $600,000, have to leave 20% equity in it. Those are the federal mortgage requirements, federal mortgage rules.
Okay.
We could take that new mortgage up to $480,000. So they owe $300,000. We can borrow up to $180,000 in money out. That comes once the mortgage is registered. It gets registered through a lawyer. They put the money right in your bank account. And so now you have that $180,000 to turn and use it for down payment, closing costs to pick up a rental property.
Yeah, so it's sort of a good way to kind of leapfrog. And if you own 3 or 4, like, you can keep on building this sort of like monopoly, if you will.
You got it. Yeah, you see the real estate empires, the guys, the individuals that use their equity very well. They continue to use the properties that they have to pull more equity out to buy new places, and they continue to do that. And it's a great way. You don't have to continue to have savings to do it. You use your properties for the benefit of building, buying a new property and building more equity, having somebody pay down your rents, having a rental property. As you know, You're managing how many properties now? 500?
98 for myself, but
98.
our company has, I think we're pushing towards 700.
700
right
properties, and you guys got, like, that's amazing. But like, that's the benefit of what you guys see as investors doing is, having a rental property, people paying down your mortgage, helping you build equity, which is just overall net worth for you. And so, yeah, using your own equity to buy another property, it's a great way to do it for sure.
Yeah, I guess it's sort of like the difference, which something they didn't teach us in school was the difference between bad debt and good debt. So like bad debt being a credit card that's just beating you up and you're losing a ton of money every
Yeah,
month
absolutely.
as it compounds away. And then good debt, which, yes, a mortgage is a debt technically, but generally speaking, real estate goes up.
You have an appreciating asset and debt paying it down. Yeah, absolutely. I mean, yeah, that's always one of the things overlooked most in school. I find I found that's credit as well. Getting into things like, I know we're going off topic here, but getting into credit. Credit's another thing that I think has plagued schools. They should be teaching credit in high school. Mm-hmm. Kids should be coming out of high school knowing exactly what a credit score is, how to maintain good credit. Most get a credit card after they graduate, go into the real world. They have no idea if they start missing payments, being a little bit immature about borrowing money too much and having debts on there. They have no idea what impact that could have 2 years down the road when they want to go buy a place and they're registering a bad credit score because they've never been taught it.
Oh yeah, I mean, coming from the bar industry, watching a 20-year-old with a credit card is it's something else. And They suddenly are buying rounds for an entire bar, thinking that there's no repercussions of this.
Totally. Free money, right?
Right.
Exactly.
So with the equity, how does one access it? Like, you've got your place,
Mm-hmm.
now that's worth about $600,000. You've watched other ones sell for that. So you have a kind of a good idea.
Yep.
But I still have 2 years left in my mortgage. Obviously, I can't just break that or take more, can I?
Yeah, I mean, we can. Keep in mind, again, this comes back to that open versus closed. In most cases, most people do have a closed mortgage. Generally, the reason why you have a closed mortgage, whether it's fixed or variable, closed mortgages are significantly lower rates than open mortgages, like a line of credit or an open variable or fixed product. Okay. So most people who are getting a mortgage get a closed. If you do want to end your term early, in most cases, you can break it. There are some lenders that have specific sales clauses in their contracts. Again, something you got to be careful about when you're signing on a mortgage. Does it have a bona fide sales clause that wouldn't let you break that mortgage before the end of the term? But assuming it's just I would say a standard run-of-the-mill mortgage, you can break your mortgage at any point. You do have to pay the penalty, and that's where we have to run the numbers to see does it make sense.
Yeah.
Is it advisable for you to break that mortgage to pull some equity out? Because we have to include that into running the numbers. Is this going to be worth it to pick up that investment property or get access to your equity?
Yeah, and so I guess because most mortgages are in a 5-year term or whatever, maybe it would make sense to, when that term's coming up, to try to hit it then.
Absolutely, yeah.
So
natural break in the mortgage at the end of the term, right? So if you got a 5-year term and you're up for renewal, let's say this July, we plan it out so that at this July, you guys have been talking about buying an investment property. We run those numbers, and in July that term's up. We can borrow equity out of there. No penalty to break that mortgage because it has come up for maturity.
So when's a good time to have that conversation about pulling out that extra equity? Like, can this be done in 2 weeks? Does it need 3 months? Like, when's
as
a
early as possible? I always say that the first thing you want to do when you're considering either upgrading your home, buying a new place, picking up an investment property, you don't know what you don't know. Even if you've bought a house and have a mortgage, you got to run through the steps of when is this going to be a good time, and is this a good time now? And so setting up a conversation as early as possible so that you can get all the information to make your decision, because it might be in that early planning stages, what we call having our educated sit downs with our clients. It might be that you've got lots of equity, but you've got a fixed rate that you've got a year left on, and it's at 2.5% right now. Maybe it doesn't make sense to break that mortgage just to pick up an investment property. If we wait the year until the term is up, no penalty, natural break in that mortgage. We refinance it at that point to pull the equity out so you're ready to go. I mean, especially with what we see in rates right now, the last thing you want to do is break a 2.5% interest rate to get something at 5%, right, just to access some equity. But at the same time, maybe the opportunity has come up that now is the time that you do need. So those are all the things we analyze when we're going through it.
And so they can basically just get a hold of you and say, hey, Chad, I'm thinking about buying an investment. You can kind of go through everything and sort of build a playbook or a blueprint, if you will, right?
Yeah, that's exactly it. Yeah, we'll sit down, we'll walk them through. First of all, we'll collect personal and financial information, mortgage application, and then from there we'll just start analyzing. We'll say, well, what's the goal here? What are we trying to do? Okay, we want to buy an investment property. Nobody is ever really, I want to buy an investment property right now. It's never that urgent, but that's where we build the plan out, and we do say, okay, this is a 2-step process. You want to buy an investment property. First thing we've got to do is refinance your home to pull the money out. We outline those costs. Here's what the new mortgage is going to look like. Here's what the penalties are going to look like. Here's all the fees. When you're ready to do that, then we pull the trigger on the refinance so that the money's in your hands, and then you're ready to go out and shop for your new purchase.
Absolutely, which is kind of nice that you talked about how it's not a super speedy thing. We see some people come in and they have watched too much HGTV and think that they're going to buy this place, do a renovation in a commercial break.
We see that all the time.
I'll make $100,000.
The calls we get for refinances, whether someone's looking to pay off debt or, again, pull money out to buy an investment. We see those calls all the time. Hey, when can we have this done? It's not a week process.
Yeah.
I tell clients on average, if they've got all of their ducks in a row, typically speaking, the soonest we can have it done is in about 3 weeks. But to budget accordingly, to make sure that it runs smoothly, there's no hiccups, I say minimum time we want to have a refinance completed in is 4 weeks.
Okay.
Yeah.
So, but definitely, I think a slower, longer, more deliberate plan would probably be the best way to go and sort of put your team together, I guess.
Totally. I tell my clients, hey, I can do it in 10 days to 2 weeks for you. Yeah. The stress isn't going to be on me, though. It's going to be on you, because I'm going to be telling you, if you want this done, I need all your documentation yesterday. But timeline-wise, we can put it together. It's just, to make things go as stressless as possible, which is the goal I always try to deliver with clients. And I know your approach is the same. The longer that we have, the better.
Yeah, absolutely.
Yeah.
Excellent. So if someone is trying to get a hold of you to tap your obvious vast amount of knowledge in mortgages, your multiple generations amount of knowledge in it, how do they find you?
Yeah, online, so ChadOyhenart.ca, I'll spell it out. So ChadOyhenart.ca is my website. Cell phone, text, email, chad@chadco.ca, super simple. Or, reaching out to you and happy for you to give an introduction as well. But online, email, text, phone, whatever works.
Absolutely. And we'll have your contact in the description of this one as well. So people who can't write down the letters, they'll be there for them.
It's always a tricky name to get, for sure. That's why I dropped it on the email. So
awesome. Well, thank you so much for joining us, Chad. If you found anything useful, please be sure to subscribe and tell your mates about our podcast. We'll be back in a couple of weeks to discuss the stats and really anything going on in the property management world. My name's Haze Hartwig. This has been Bamboo, Vancouver's property management and investment podcast.